Imagine you find a brokerage statement, crisp, yellowed at the edges, dated September the 1929. The name on the account belongs to one of the wealthiest men in New York. His portfolio is enormous, and in 6 weeks, most of it will be gone. This isn't a story about greed exactly. It's a story about what people believed was safe, what counted as diversified, what felt to every rational investor of that era like an ironclad plan for generational wealth. And it's a story that should make every modern investor pause, because the assumptions that destroyed his fortune are not as distant as you might think. Let's open that brokerage account. Let's see what he owned. The first thing you notice is the sheer confidence of the portfolio. American stocks wall to wall. No foreign holdings, no international bonds, nothing from London or Paris or Tokyo. In 1929, nearly every wealthy American investor held almost exclusively domestic assets. And why would it? US stocks had returned nearly 20% per year, on average, for the 5 years leading up to the crash. Every year better than the last. Every year proof that you were right to stay in. The engine of the 1920s portfolio was railroads. Not technology, not finance. Railroads, steel, and oil dominated the Dow Jones Industrial Average. These were the infrastructure of the modern world, the internet of their era, and wealthy investors treated railroad bonds like today's treasury notes. Reliable, respectable, the foundation of any serious portfolio. Railroad bonds yielded between 5 and 6% annually in the 1920s. That was real money, steady income, the kind of return that let a family live well without touching the principal. Conservative investors built their entire financial lives around that yield. But here's the thing about bonds. A bond is simply a loan you make to a company or a government, and in exchange, they pay you interest on a fixed schedule. Our 1929 millionaire understood bonds. What he perhaps did not understand was how much risk was hiding inside everything else he owned. Because alongside those railroad bonds sat something newer, something more exciting: investment trusts. Think of an investment trust like an early mutual fund, a vehicle that pools money and buys a basket of stocks, so individual investors get exposure to many companies at once. Sounds sensible, sounds modern even. Except that by 1929, there were over 700 of these trusts, up from just 40 in 1921, and many of them were using borrowed money, leverage, to amplify their bets. Leverage means borrowing to invest. If a trust uses $3 of borrowed money for every $1 of real capital, a 10% market gain becomes a 40% return. Spectacular on the way up, catastrophic on the way down. Goldman Sachs launched its own investment trust in 1929, right at the top of the market. By 1932, it had lost 95% of its value. Investors who felt like they were buying sophistication were buying dynamite. And then there was margin. Our millionaire almost certainly had some portion of his stock portfolio purchased on margin, meaning he borrowed money from his broker to buy more shares than he could actually afford. Broker call loans, the total margin debt across the entire market, reached $8.5 billion by October 1929, up from just $1 billion 8 years earlier. Margin amplifies everything. It turns a 30% market decline into a wipeout. When prices fell, brokers issued margin calls, demands for immediate cash, and investors who couldn't pay were forced to sell, which pushed prices lower, which triggered more margin calls. A spiral with no floor. Now, let's look at the real estate corner of this portfolio, because here, the story gets darker earlier than most people realize. Wealthy investors in the early 1920s poured money into Florida land, convinced that the Sunshine State was the future of American prosperity. Land prices exploded, then they collapsed. 3 years before the stock market crash, the Florida real estate bubble had already burst. And commodities. A surprising number of wealthy 1920s investors traded futures contracts in grain and cotton. A futures contract is an agreement to buy or sell something at a set price on a future date. Used poorly, they are one of the purest forms of speculation. In the 1920s, they were mostly used poorly. Then there was gold. Every portfolio of this era held some relationship to gold because gold was the foundation of the entire monetary system. The price was fixed, $20.67 per troy ounce, and had been for decades. It felt permanent, immovable, the kind of anchor that gives an investor a sense that at least something in the world would not change. It would change. In 1933, Franklin Roosevelt devalued the dollar, and gold was repriced to $35 an ounce. Even the immovable things moved. So, what did this portfolio actually look like? Imagine a pie, roughly half in individual stocks, much of it on margin, a significant slice in investment trusts, many of them leveraged, railroad and government bonds for income, some real estate, perhaps still recovering from Florida, a scattering of commodity positions, and almost nothing outside the United States. And here is what is striking. That portfolio looked diversified to the people who built it. It had multiple asset classes. It had income-producing bonds alongside growth-oriented equities. It had real assets like property and commodities. By the standards of the day, this was a sophisticated, well-constructed portfolio. But there was no protection underneath it, no government insurance on the brokerage account, no regulatory body ensuring the investment trusts were honestly run, no circuit breakers to pause a market in freefall. When things went wrong, they went wrong completely and simultaneously. Only about 1.3% of the American population owned stocks at all in 1929. This was not the broad middle-class market we know today. Investing was the domain of the wealthy, and yet even the wealthy were devastated. The Dow Jones Industrial Average peaked at 381 points on September 3, 1929. By July of 1932, it had lost 89% of its value. That is not a correction. That is an extinction event for a portfolio. There were exceptions. Bernard Baruch, one of the most celebrated financiers of the era, moved heavily into cash and government bonds before the crash. He saw the speculation for what it was. He got out. He preserved his wealth while his peers were ruined. But Baruch was the exception so rare that history still names him specifically. For every Baruch, there were thousands of wealthy, intelligent, well-advised investors who stayed in and lost nearly everything. Now step forward to today. Open a modern brokerage account for a similarly wealthy investor, and the architecture is almost unrecognizable. The assets are different. The protections are different. Even the definition of a sensible portfolio has been rebuilt from the ground up. Technology stocks now represent roughly 30% of the S&P 500 by market capitalization. Railroads and steel, which dominated that 1929 portfolio, are a rounding error. The economy itself has been restructured, and the modern portfolio reflects that restructuring. Modern wealthy investors typically hold 15 to 20% of their portfolio in international assets, stocks and bonds from Europe, Asia, and emerging markets, and another 5 to 10% in alternatives like private equity or real assets. Geographic diversification that our 1929 millionaire never considered is now considered basic hygiene. The index fund, a simple product that owns every stock in an index at very low cost, did not exist in the 1920s. Every investment required active selection, a broker, a fee, and a judgment call that could be wrong. The democratization of passive investing has changed not just who invests, but how survivable a market crash is for ordinary people. There is also the regulatory architecture built after the crash. The SEC was created directly in response to the abuses of the 1920s. FDIC insurance now protects bank deposits up to $250,000. Margin requirements are regulated. Investment products must disclose their risks. None of this existed when our millionaire signed his brokerage statements. But here is where the modern investor should feel something uncomfortable. Because the emotional logic that built that 1929 portfolio, the conviction that recent returns predict future returns, that leverage accelerates wealth safely, that the structure holding everything up is permanent, that logic is not gone. It visits every generation wearing different clothes. The 1920s investor believed railroad stocks were the safe, obvious choice. A different era believed it was dot-com companies. Then it was real estate. The specific asset changes. The psychology does not. What made the 1929 portfolio truly dangerous was not any single holding. It was the hidden assumption running through all of them that the system itself would hold, that the rules were stable, that the leverage was manageable, that the losses would be temporary. Every investor who was ruined believed until the very last moment that they were doing the sensible thing. That is the most chilling part of this story. Not the crash itself, but the confidence that preceded it. Real diversification is not about owning many things. It is about owning things that fail for different reasons at different times. The 1929 millionaire owned many things that all failed for the same reason, at the same moment, all at once. Now go back to that brokerage statement. September 1929. The name at the top, the columns of holdings, the total value that represents decades of work and ambition and careful, rational decision-making. The lesson is not that he was foolish. The lesson is that he was reasonable by every standard available to him. His diversification was real by the knowledge of his time. His confidence was earned by the returns of the previous 5 years. His assumptions were shared by nearly everyone around him. The difference between that portfolio and a resilient modern one is not intelligence. It is infrastructure. The slow, hard-won architecture of regulation, transparency, and genuine diversification that societies build after catastrophe, not before it. Every investor alive today holds something that investor did not: the institutional memory of what happens when that architecture is missing. The question worth sitting with, quietly, honestly, is whether you are using it.